So welcome to Accounting 10. This is the lesson that goes along with the 1.1 financial position. If you have a textbook, you can follow along with us on page 2 to 14. So today's lesson is going to be just to inform you of some basics that has to do with accounting. And we're going to talk about what financial position means. We're going to talk about assets, liabilities, and owner's equity. Those are the three main important things that we are going to build upon for this whole entire course. The most basic sheet that we're going to do is we're going to make something called a balance sheet. And on the balance sheet, we are going to be calculating the owner's equity. We're also going to talk about just some general procedures that you use when you're filling out, making a form for either your banker, for the person you're asking for a loan for, and so forth. So when we're talking about a financial position of an individual, we're talking about everything that they either own or they owe. And the textbook uses a person by the name of Su Lin Wong. And at the bottom here, you can see that she's gone into a bank and she's wanting to take a loan out to start her own landscaping business. And the bank has asked her to provide her a list of all of the things that she owns. She has cash worth $4,000, government bonds worth $5,000. Government bonds are like a savings plan that you can turn into cash. She has clothing worth $3,000, furniture worth $15,000, equipment worth $10,000, and an automobile worth $20,000. So this is an important number, this $57,000. She owns $57,000 worth of goods. Now, a really important part as well is kind of the opposite of what you own, and it is what you owe. She has credit card debt of $2,000, and she has a bank loan for $10,000. This total is very important. That $12,000 represents what she owes to creditors. Now, the bank is going to want to see what her financial position is. They're going to take what she owns, and they're going to take away what she owes to people. Her net worth is $45,000. When you subtract, so we're taking our assets minus our liabilities, or what we own minus what we owe, gives us a net worth of $45,000. Okay, so I kind of used these words already, but assets are anything that somebody owns. And in Su Lin's case, $57,000. Liabilities are anything that somebody owes. And in her case, she's $12,000. Her personal equity is anything, when you take your assets minus your liabilities, it gives you the $45,000. If we were to look at a balance sheet, this is what a basic balance sheet looks like. The top three lines would have the name of the person or the company in which you're making this balance sheet for. You then always write in the second line, what is your personal balance sheet? And you always put the date, because at any time you might have to produce a balance sheet. And we always want to know the date. So, important aspects of a balance sheet. On the left-hand side is always your assets. You list your assets in order in which they can be turned into cash. Now, I'm not really too sticky on this, but cash is already cash, so it's already listed first. Government bonds, you can just take them to the bank and you can turn them into cash. That's why they're listed second. Then we get clothing, furniture, equipment, all that stuff you have to sell, and it might take a little while to turn into cash. So on the left-hand side, you've got your assets. A single underline in accounting represents that you are adding. So now you are adding all of these numbers together to get your total assets of $57,000. And you need to have the total assets listed there as well. Now on the right-hand side are our liabilities. Liabilities are what you owe. Credit card debt, bank loan. Single underline indicates you're adding. You need to have the total of $12,000 here, and you also have to have the heading here, total liabilities. The third and the final section of a balance sheet is your personal equity. And to find your personal equity, you take your $57,000 and you subtract your $12,000. That's how you come up with the $45,000. This single underline here indicates that you are adding the $12,000 and the $45,000 to come up with the $57,000. The left side and the right side of your balance sheet must equal. If they don't, you know you've made a mistake somewhere and you have to go back to find where you've made that mistake. The $57,000 has to be written on the same line. So you might want to do the part here on the assets, leave a little bit of a space and move over to your right-hand side and figure out where your last line is going to be. When you know your last line where it's going to be, then you can scoot over and put this final line in here. The last thing you have to do is if your left side equals your right side, you need to double underline. Double underlining in accounting indicates that your work is balanced, therefore the word balance sheet. Okay, we also can do this exact same thing, finding a financial position, but now for a business. Okay, so throughout the textbook, they talk about a person called Preya Ramdas. And I just want to give you a little background on her because they introduce her kind of throughout the whole textbook. She opened Physio Central, which is a physiotherapy clinic in Hamilton, Ontario. Many factors influenced Preya to open her own business. Preya's formal education was first in kinesiology and then in physiotherapy. That education plus 5 years of practical experience in a business physiotherapy clinic working with clients on a range of injuries provided the expertise and confidence necessary to operate a physiotherapy clinic. Preya felt that her capacity for hard work coupled with her desire to succeed made it likely that she would become a successful entrepreneur. When starting out, the owner of any business takes risks in the hope of being successful. When a good location became available, Preya decided the time was right. She collected all available cash and with the backing of her parents, she applied for a loan and mortgage from the bank in order to establish her clinic. A mortgage is a loan that you take out for a home or a building and it's spread out a number of years, like usually 25 years. Preya Ramdas had to make many decisions as she developed the clinic into a successful business. One important decision involved selecting the method of keeping accurate financial records. Since reliable financial information is required in order to make money, make many other important decisions. This fact serves to introduce the subject of accounting. So this is where somebody like Preya Ramdas would use accounting. Okay, so there's two main purposes of accounting. You want to always record the day-to-day financial activities of your business because you need to have a paper trail. And the second thing is you want to be able to, at the end of the year or the end of the month or the end of the day, summarize and report how your business is doing. If you don't analyze or decision make based on those numbers, your business is probably not going to do very well. Throughout the textbook, you'll hear a few principles. Accountants, or people who do accounting, have a set of rules they need to follow. The first one is called business entity principle. Basically what that means is that anything that's your own personal items stays separate than your company items. So if you are keeping track of your accounting, business stays with business, personal stays with personal. Okay, and when we're doing a balance sheet, we do a balance sheet exactly like we showed you earlier, but now instead of it being for your personal use, it is for the company name, Physio Central. So if you take a minute to have a look at this, they've listed all the assets that her company has, the liabilities and the owner's equity. And do you see how the formatting is the same? Single underlining showing adding, double underlining to show that it is imbalanced. And then very important that the last two numbers are on exactly the same line. So when you're doing this in your books, you might find that there will be a few extra spaces in this area here to ensure that these two numbers are on the same line. Okay, just also in the owner's equity section, owner's equity is what is left in the owner's pocket after they take all their assets minus all their liabilities. When we're recording the capital, we always want to use the company or the owner's name So P. Ramdas, to show that that is her capital in this business. Because some businesses have more than one owner, and you'd have to list them separately. Okay, the second thing here on the bottom is total liabilities and owner's equity. So like I had said, so that's what I just read here, total liabilities and owner's equity. To get the 241,000, we added the liabilities and the owner's equity or the capital. Okay? Okay, so I won't go through all this. It is in the textbook because I've already gone through it with you. It talks about how to prepare the heading. It talks about the asset side, always on the left side. Talks about the liabilities, which is always on the right side. And it's a good idea to leave spaces between your titles and the numbers that you're listing, just so it makes it a little bit neater for the person to be able to read. And then owner's equity as well, which I've already talked to you about. Okay. Okay, I've kind of covered most of this too. Some types of assets. Cash, of course, is an asset because it's already cash. It's something that you can use to buy immediately. We also have something called accounts receivable. For some businesses, they allow their customers to put things on bills. So when people come in and they don't want to pay cash, they will put it on a bill. That is called your accounts receivable. It is considered an asset because it's going to be turned into cash eventually. And usually the terms are within 30 days. We also have something called office supplies. It would be like paper, computers, any kind of supplies that your office uses. That is also considered an asset because you could sell it and turn it into cash. In the liabilities department, we also have accounts payable. When we, as a customer or as a business owner, go in to buy something, we don't always have to pay cash. We can put it on a bill. If that's the case, it's due within 30 days. That's called accounts payable. It's something we own or we owe, and that has to be paid within 30 days. Bank loans are another type of liability, and same with mortgages. And remember, I told you that mortgages are a long-term loan that goes over usually 25 years. And then we have equities, which is just basically your owner's equity goes in here. Okay, we talked a little bit about the order in which things are listed in each section. And like I said, I'm not really fussy on this. It just tells you that the most liquid asset, meaning what can be turned into cash the quickest. And so they've given you an example here of ways or the order that you could list your assets, and same with liabilities. Okay, like I said, I'm not sticky on that. Okay, we also have something called cost principle. And now this is another principle or guideline. And assets are valued according to the cost principle. When a business acquires an asset, the value of the asset is recorded and its actual cost to the business, either its acquisition cost or its construction cost. So depending on how you keep your books, and you have to keep it constant. When you buy something, you either list it at the price that you have bought it for, or you list it as the price that it is actually worth. And you can decide as a business owner, but you have to stay consistent. Okay, there are two main groups of people that use accounting information. The two main groups are yourself as the owner. Okay, so we can have owners and management. They would want to know how your business is doing. We also have banks, creditors, and potential investors, and government. Okay, and this is kind of a list of the reasons why they would want to have information about your books on your company. You can have a second to look over that. Basically, if you go in to get a loan from your banker, the banker will not give you a loan without seeing some of your financial statements. They need to know that your company is making money and that you're making good financial decisions. Okay, two main things. There's a difference between The terms accounting and bookkeeping are sometimes used interchangeably. However, there's a difference between the two in practice. Bookkeeping is kind of the first part of the accounting process. You are entering stuff into the computer. If you are actually the accountant now, not only are you recording, but you're controlling and analyzing and interpreting the information. So bookkeeper wouldn't really provide financial advice to the company, but if you are the accountant, your job is to make sure that that company is running to the best of its abilities. Okay, and I kind of talked about this before too, kind of some common practices. Single underline to show that you are adding, double underline to show that everything is accurate and your totals are done. In your workbooks, you're going to be using ruled accounting paper that have, you can't really see this very well, but this part here is going to be white, I believe, in your book. And this part over here is going to be green. And you're going to have white lines in between. The one at the back is for the cents, the ones, the tens, and then the hundreds, and the thousands. You don't need to use dollar signs because the ruled paper indicates that we're going to be using dollars. Yeah, so I think everything like that. We don't usually use abbreviations unless you're running out of room. You need to have things to be neat, spelled properly, capitals in titles. If you make a mistake, you erase it lightly in your workbook because the paper could rip. It's quite thin. Yeah, so anyway, that's the end of our first lesson. If you need to go back to listen to some of that, you're more than welcome to. If not, continue on in the lesson and your assignment is listed.